Adobe reported earnings last week and the stock jumped by 15%, taking the company's market value to $235 billion. With $8 billion of cash and investments on its balance sheet and $4 billion of debt, the enterprise value is $231 billion. Revenue over the last 12 months comes to $20.4 billion, with just over $5 billion of net income and $6.4 billion of free cash flow. So Adobe's stock is now valued at 11 times revenue and 46 times earnings. That seems like an expensive valuation, but that's because Adobe is one of the best businesses in the world. Revenue has grown every year for the last 10 years at a compounded annual growth rate of 17%. Earnings per share has grown continuously too, supported by recurring revenue streams and share buybacks. And the latest quarter provides more evidence of Adobe's quality. Revenue grew 10% year over year, which was above analyst estimates, and the company raised its targets for the rest of the year. Crucially, management said on the earnings call that they're seeing strong uptake for the company's new generative AI products such as FIrefly, and these products are bringing in new users into the Adobe ecosystem. This is important because the bear case against Adobe revolves around new AI products taking market share. That isn't happening yet. But despite Adobe's strong quarter, there are some reasons to be cautious about the stock. Last Monday, the Department of Justice and Federal Trade Commission filed a lawsuit accusing the company of using hidden fees and making it nearly impossible to cancel annual subscriptions. According to the lawsuit, Adobe has consistently violated the Restore Online Shoppers Confidence Act, and there was uproar on social media recently when Adobe changed its terms of service. As highlighted by Sasha Jansen, the new terms give Adobe royalty-free license to its users' content. Adobe tried to backtrack, and it's clear that a variation of these terms has existed for several years, but there's an obvious concern that Adobe wants to use customers' content in order to train their AI models. After learning about this, some users pledged to boycott Adobe products. All that said, it's exceedingly difficult to bet against a company that has executed so well and still has a long runway ahead. A bigger obstacle for investors is the valuation. A simple discounted cash flow model that assumes 12% annualized revenue growth and 35% free cash flow margins for 10 years with a 10% discount rate and a 2.5% terminal rate results in an expected annualized return of only 7% per year. And note that this year's revenue growth should be around 10%. Given its history, Adobe probably does better than that, but even so, the stock doesn't look very cheap. But these are my personal opinions, not financial advice, and I hold no position in Adobe. For more investing videos, make sure to join my newsletter at 3minutebreakdowns.com. Thank you for watching.